on guys, it's Aaron from Market Alert, giving you your daily market alerts for stocks. And boy did we have an interesting week last week, especially with Netflix. Ending a week on a high of 6.68% at $423.05 and with a midweek high of $448.91, a 13.2% increase from the beginning of the week. Netflix has gained 31% so far this year. So what caused Netflix to skyrocket, and what does this mean for the future of the stock this week? But before we get into it, if you like what we do here, smash that like button and subscribe for more market related updates. And be sure to comment below your thoughts on how the market will pan out this week. Now back to Netflix and its amazing performance. Netflix set an all-time high last week as investors' optimism bubbled over a potential spike in member growth. Consumers around the world are spending more time at home, and having seen other entertainment options like movie theaters, theme parks, and sporting events drop off the menu, Wall Street is betting that a shift in good news for the streaming video industry's biggest subscription service. Member gains will be closely watched in Tuesday's report, since they could land significantly above the official forecast of 7 million additions. A key question is whether Netflix can approach or exceed its blockbuster prior year mark of 9.6 million new signups. Yet investors might even be more impressed by any engagement metrics that the company reveals, since that trend supports steadily rising monthly prices. Finally, for an optimistic short-term outlook from CEO Reed Hastings, Netflix focuses on using this moment to launch valuable content franchises from its massive entertainment platform. But there are some risks that Netflix may face in the not-so-distant future. On March 13th, news broke that Netflix had shut down its production of original content in the US and Canada for 2 weeks. Then on March 22nd, Netflix Chief Content Officer Ted Sarandos said in a CNN interview, "It's been a massive disruption. Everyone on our productions around the world is shut down." The company paid its production staff for 2 weeks following the shutdown and set a $100 million relief fund for unemployed production staff, including cast and crew. While Netflix's surging viewership and engagement during the economic shutdowns has been well documented, one of the looming risks has been the potential for Netflix's new content releases to dry up if production remains shut down for too long. After all, part of Netflix's massive global appeal is a steady stream of new content that hits the service on a continuous basis. That helps new subscribers and retain existing ones. But limited new content releases for an extended period of time could change subscribers' perception of the service. If more start to think that Netflix's content is getting stale, and they start to question the value proposition of the subscription, since they haven't noticed any compelling new content in a while, Netflix could see elevated levels of subscriber churn or cancellations. In the CNN interview, Sarandos addressed this risk by saying that he didn't see any disruption to the new content release schedule for the next few months. Here's the full quote: "We work pretty far ahead. We deliver all of our shows with all episodes at once. So we're pretty far ahead. So we don't see any disruptions in our output over the next few months. Maybe later in the year, if this progresses long, you'll start feeling some of that as the physical production is not operating." If the shutdowns and the physical distancing continue beyond the next few months, this risk could start to play out. Certainly, some genres like animation could probably continue, but this production issue made Netflix not entirely immune to COVID-19 related risks, despite the skyrocketing engagement the company appears to be seeing at this moment. It's also been reported that a wide array of film studios were pitching their completed movies to the streamers like Netflix, Amazon Prime, and Hulu. These are movies that were intended to be released in the theaters, but will not be right now because the theaters are closed. Even when theaters reopen, they may see substantially smaller audiences for a while, until an effective vaccine for COVID-19 is widely available. The studios would rather license these movies to the streaming services and get some certain revenue now, rather than wait up to a year or longer for more uncertain revenue. Hulu has received over 50 movie pitches from these studios, while Netflix has received more than 100, and new pitches are being received on a daily basis. A huge surge in movies being pitched to Netflix has made the company even more selective. In fact, reports indicate in one case, Netflix cut its offer for a particular movie by 20% relative to what they would normally bid. Considering there's so much content supply for Netflix to choose from, and that the company is being so selective, suggest that Netflix is unlikely to face a dearth in new content for its service. As a result, it now seems that the risk of its new content release pipeline drying up is off the table. Investors should now see nothing but tailwinds for Netflix as a result of COVID-19. Well, there you go, guys. My thoughts on Netflix and its future. Thanks a lot for tuning in to Market Alert. If you like what we do here, be sure to hit that subscribe button. I'll catch you guys on the next one.